Benjamin Graham, The Intelligent Investor. Are you ready to embark on a profitable journey with the guidance of Benjamin Graham's The Intelligent Investor? This book summary offers you vital nuggets of wisdom for wise and secure investment strategies. Learn to differentiate between intelligent investing and speculating and discover the principles that all intelligent investors must follow. The book further explores essential investment strategies for defensive and enterprising investors and provides valuable insights on how to be prepared for market fluctuations. Dive in and equip yourself with the knowledge of intelligent investing to secure protection against potential losses and ensure safe, steady revenues.
The art of intelligent investing. Investing can be a risky venture, leading to either tremendous rewards or devastating losses. However, intelligent investors can significantly increase their chances of success and keep their money safe. The book highlights the importance of investing intelligently by thoroughly analyzing a company's propensity for growth before making any investment decisions. A fundamental difference between speculators and intelligent investors is that the former focus on short-term gains while the latter prefer safe and steady returns. A speculator may make an investment decision based on a rumor or market fluctuations, which makes it impossible to predict future outcomes. However, intelligent investors focus on the pricing of a company's stock and buy it only when its price is lower than its intrinsic value. Intelligent investors believe in a probable margin between the price paid and the earnings obtained when the company grows. This principle is similar to shopping, since buying an expensive dress is only worth it if it lasts for a reasonable duration. The art of intelligent investing is not exciting, but it promises profit. In summary, investing can be worth the risk if it's done intelligently, and by focusing on prudent analysis and rational pricing, anyone can reduce their risk of losing their investments and improve their chances of financial success. Principles for intelligent investing. Intelligent investors analyze long-term development and business principles, diversify investments, and aim for safe and steady revenues. To become an intelligent investor, you must first analyze the long-term development and business principles of companies before investing. It is important to consider the company's financial structure, management quality, and dividend payment history to evaluate the stock's long-term value independent of market trends. Next, diversify your investments to ensure that you are not putting all your money into one company or stock. By doing this, you protect yourself from serious losses in case a company that you have invested in gets involved in a scandal. Lastly, remember that the goal of investing is to meet personal needs, not to outperform professional stockbrokers on Wall Street. Intelligent investors understand that chasing fast money only leads to greed and carelessness. By aiming for safe and steady revenues, you can ensure a steady return on your investment without taking unnecessary risks. With these principles, anyone can become an intelligent investor. The importance of understanding stock market history. Understanding the history of the stock market is crucial to making wise investments. The market has always been characterized by ups and downs, and economic crises are inevitable. Investors must be prepared psychologically and financially to withstand unpredictable fluctuations. Diversifying your portfolio and not panicking during downturns are key strategies. Additionally, analyzing a company's earnings, dividends, and inflation rate is crucial to making sound investments. By gaining knowledge of the market's history, investors can make informed and shrewd decisions. Mastering the art of intelligent investing. In this book, the market is depicted as a person, Mr. Market, who is unpredictable, moody, and easily influenced. Mr. Market's mood swings cause prices to go up and down, leading to the market being too optimistic or pessimistic. The intelligent investor should ignore Mr. Market's swings and be a realist. The book details instances where Mr. Market's happiness can cause investors to be tricked. People easily recognize patterns, leading them to believe short-term gains will continue, but this is not always the case. The book presents basic principles of intelligent investing and follows up with practical investment tips. Smart investing strategy. As a defensive investor, your focus is on safety, and diversification is key to achieving it. Split your investments between high-grade bonds and common stocks. For common stocks, invest in big, well-known companies with a long history of success, and diversify your portfolio. Use established investment funds as a guide. Always seek the advice of an expert, and good results will follow. Formula Investing for Defensive Investors. Congratulations, you have picked the companies you want to invest in, so what's next? It's now time to determine the amount of money you want to regularly invest and check the stocks periodically. To do so, you will use a formula investing process, also known as dollar cost averaging, to invest in common stocks every month or quarter using the same amount of money. Once you've identified a safe stock, set your investments on autopilot by committing yourself to a specific amount of money you can invest every few months. With this approach, you won't gamble and risk investing too much. However, formula investing demands emotional stability that may be difficult to manage when you come across a real bargain for your target stock but cannot exceed your limit. Defensive investors should check their portfolio every 6 months to ensure it still runs well and readjust the stock-bond ratio, if necessary. Lastly, seek professional advice annually about adjusting your funds. With these strategies, you have all you need to become a defensive investor and a successful enterprising investor in the future. Smart investing strategies. Successful enterprising investors utilize similar strategies to defensive investors, such as dividing their funds between bonds and common stocks. However, enterprising investors tend to invest more in common stocks and view their financial planner as a partner rather than a teacher. They also experiment with other kinds of stocks that have higher risk and reward, but limit them to a maximum of 10% of their portfolio. Continual research and monitoring is essential to maintain profit flow and protect against economic downturn or poor investments. Smart stock investment strategies. Smart investors know that trading in the market based on fear of financial loss is unwise. This approach is based on guesswork rather than analyzed investment strategies. Trusting Mr. Market can result in risky investments, as was the case with the U.S. housing market crash. To avoid such scenarios, investors must regularly check their portfolio, examine the companies they invest in, and ask questions about management and financial situations. If a company's stock's growth is not consistent with its true value, it's better to sell before it crashes. It's smart to buy in low markets, as Yahoo Incorporated did in 2002 when it acquired Inktomi Corporation at a bargain price of $1.65 per share. Instead of blindly following market trends, intelligent investors make calculated investment decisions by analyzing the market, the financial situation, and management's performance. Such strategies help investors maximize profitability while minimizing the risk of financial loss. Enterprising investing for beginners. Discover how to hone your skills in investing and find the best bargains through virtual tracking and bargain hunting. If you are looking to become an enterprising investor, it is important to start smart and learn the ins and outs of investment. One of the best ways to do this is by investing virtually for a year to develop your ability to pick out a bargain and track your stock's progress. Fortunately, there are numerous websites that allow you to make virtual investments. By participating in a year-long practice period, you can gain practical experience and free yourself from fantastic expectations. Once you've had the chance to develop your skills virtually, you will be ready to start bargain hunting. The best bargains can often be found in undervalued stocks of companies that are either temporarily unpopular or suffering economic losses. Imagine, for example, a successful refrigerator company that experienced a temporary dip in profits due to a production error. As a result, the company's share prices may plummet, presenting an opportunity for intelligent investors to make a great bargain. While finding these bargains can be challenging, your virtual experience will prepare you for entering the real world of investing. By following these steps, you can become a proficient enterprising investor and achieve better than average results.
As you reach the end of this informative book summary, you have gained essential knowledge of the importance of intelligent investing, distinguishing it from speculation. By understanding the principles like analyzing long-term developments, diversifying investments, and focusing on steady revenues, you are well on your way to becoming a successful investor. Additionally, grasp the importance of knowing your investment style, whether defensive or enterprising, and the unique strategies for each. Finally, learn the value of historical knowledge, ignoring Mr. Market's mood swings, and honing your stock-picking skills. With the foundation set, you are all set to put this knowledge into practice and embark on your investment journey with confidence.